There is an adage that states that whenever America sneezes, the entire world catches cold. However, what occurs when China is unwell? How big of an obstacle these challenges are for Beijing? However, is it really that much for the rest of the world? Welcome on board today as we explore some of the issues currently affecting the second largest economy in the world, China. Over the past several weeks, public conversations have increasingly focused on structural concerns, including debt, demography, and China's worsening relationship with the West. As a result, sentiment about China's economy has become more negative. We shall examine the many views and the evidence that supports them, talk about actions for assessing the success of the Chinese economy in the future, and weigh the implications for the US and the rest of the world. Let's look a bit into the recent history of China's economy. Over the past 3 decades, China's economy has performed remarkably well, with steady and strong development that has driven the country from a low income to an upper middle income position. China's GDP, calculated using market exchange rates, was $18.3 trillion in 2022, accounting for 73% of the US GDP and 10 times more than the 7% share it had in 1990. China's per capita income has increased to around $13,000 from less than 2% in 1990 to almost 17% of US per capita income now. China has been the primary engine of global economic growth during the last 15 years, contributing 35% of the nominal GDP growth worldwide, with the United States contributing 27%. China was able to do this without many of the factors that economists have recognized as critical to growth, including a solid institutional framework, a market-oriented economy, an open and democratic political system, and a well-functioning financial system. The Chinese economy seemed to be unaffected by times of local and international restlessness until the COVID-19 pandemic turned it upside down. However, critics have long maintained pointing out several vulnerabilities that China's economic collapse was approaching. Investment in tangible capital, particularly real estate, has fueled the nation's expansion and has been made possible by an ineffective banking sector. Some observers claim that the time for reckoning has now arrived because of the high and growing levels of domestic debt, the collapsing real estate market, and the declining workforce. Could they be wrong? Please share your thoughts in the comments section below. But did you know that the growth of investments, which are supported by an ineffective banking system, has been a major driver of China's economic performance? Following the start of the 2008 global financial crisis, this tendency became more obvious. During 2009-2010, increased investment accounted for around 2/3 of GDP growth. More investment is probably preferable to less since China is a labor-rich economy with a capital-to-labor ratio significantly lower than that of advanced nations. But rather than the independent sector, the public or state sector has been generating a large portion of the investment. This is not an issue per se compared to huge state-owned organizations. Investing in private sector firms, especially smaller ones, might carry a much greater risk. However, in China, the state-owned businesses that receive an excess of bank loans as a group have not always produced high returns on their investments. The Chinese government assigned itself the goal of rebalancing the economy after realizing that its growth strategy had been ineffective and fiscally disastrous. This implies lowering reliance on growth that is primarily driven by investments and shifting the focus of GDP growth to household spending, causing the services sector to grow more than low-wage, low-skill manufacturing, moving away from growth that is primarily dependent on physical capital in a way that enhances employment growth. In reality, household consumption has taken the lead in driving development in recent years. Nearly half of all jobs and over half of the yearly GDP are currently generated by the services industry. Now, with over 1.4 billion people living in the world's second largest economy, the country is currently dealing with several issues, such as slow growth, high youth unemployment, and a chaotic real estate market. The chairman, Evergrande, who is the nation's heavily indebted real estate developer, has been placed under police surveillance, and the country's shares have been suspended on the stock market. Is there an impact on the world economy if Chinese people start eating lunch outside more often? Questioned Deborah Elms, Singapore's Asian Trade Center's executive director. The answer is not as big as you might think, but it still affects businesses that directly depend on domestic Chinese demand. Household spending reductions would hurt hundreds of large international corporations like Apple, Volkswagen, and Burberry, who rely heavily on China's huge consumer market for their income. The hundreds of suppliers and employees who depend on these businesses worldwide will then experience the ripple effects. Considering that China accounts for about 1/3 of the global economy, any slowdown would have an impact outside of its borders. The U.S. credit rating firm Fitch reduced its projection for global growth in 2024, quoting China's slowing as casting a shadow over global growth possibilities. Some economists, meanwhile, contend that the notion that China is the driving force behind world growth has been exaggerated. Yes, mathematically speaking, China is responsible for almost 40% of global growth, but who benefits from this growth? China has a huge trade surplus. China sells far more than it imports, thus the extent of its growth or lack thereof truly says more about China than the rest of the world. However, if China spends less on housing and other goods and services, the demand for commodities and raw materials will decline. The nation's imports decreased by about 9% in August of last year, when there were still no COVID limits in place. Large exporters like Brazil, Australia, and several African nations would be most negatively impacted by this. But have you wondered why worries are being raised about decreasing pricing in China? Prices in China will remain low due to the country's weak demand. In the eyes of Western consumers, it would be a welcome alternative to further hike interest rates in order to slow down price increases. I think this is fantastic news for those who are having a hard time managing excessive inflation, because the short-term downturn in China can be beneficial for regular consumers. However, there are longer-term issues for those living in poor nations. China is thought to have spent over $2 quadrillion over the past 10 years on the massive infrastructure projects collectively referred to as the Belt and Road Initiative. China has sent funds and technology to more than 150 nations to construct highways, airports, seaports, and bridges. Mr. Raja claims that if domestic economic issues continue, Chinese commitment to these projects will begin to weaken. He continued by saying that Chinese banks and businesses would no longer be as willing to spend lavishly on other nations. You may wonder, when did prices start to decline? Following the lifting of pandemic restrictions, consumer spending rose in the majority of wealthy nations. Individuals who had accumulated savings found themselves with more money to spend, and companies found it difficult to meet the demand. Prices were inflated by the sharp rise in demand for products, the scarcity of which was further compounded by the growing cost of energy following Russia's invasion of Ukraine. However, this is not what occurred in China, where the economy recovered from the toughest coronavirus regulations in the world without rising costs. Prices for consumers last decreased in February 2021. They dropped early this year as a result of low demand and have been on the verge of deflation for months. Factory gate prices, the costs imposed by Chinese manufacturers, have also been declining. It is concerning because it demonstrates that China's demand is low while the rest of the world, particularly the West, is starting to wake up. China won't benefit from deflation. There will be a rise in debt. Since China manufactures a sizable amount of the items marketed worldwide, none of this is good news. A long time of deflation in the nation may have the advantageous effect of containing price increases in other regions of the world, such as the UK. However, firms in other nations may suffer if cheap Chinese goods expand on international marketplaces. That may reduce corporate investment and job opportunities. A period of declining prices in China may have an adverse effect on consumer spending and company earnings. The result might be more unemployment. Global exports may be negatively impacted if the nation, which is the largest market in the world, saw a decline in its demand for food, energy, and raw resources. China's economy already faces several challenges. It is, for starters, recovering from the pandemic's effects more slowly than expected. According to official data, China's imports decreased by 12.4% in July, compared with a 14.5% decline in exports. The poor trade statistics add support to worries that this year's growth in the nation's economy may weaken much further. Following the almost complete failure of its largest real estate developer, Evergrande, China is likewise coping with a continuing crisis in the real estate sector. While putting forth the impression that everything is under control, the Chinese government has refrained from taking any significant action to promote economic expansion thus far. We think that improving consumer and investor confidence will be key to China's economic revival. Prasad, a Cornell University trade policy and economics expert, also offered advice on this. The true question is whether the government can restore trust in the private sector, which it hasn't done yet, so that people will start spending instead of saving, and firms will begin making investments. Let's find out as we stay updated on this channel. Don't forget to like and hit the subscribe button as we bring you more insights on the economy. Thank you for watching. See you in the next video.